Okay, let's get back to the story of the markets today, where things are a little calm compared to yesterday. There was notable selling pressure. TSX, bit of a cautious start, but the S&P and the NASDAQ are higher on a day where we saw some economic data which pointed to weakness in the jobs market. Let's get some more perspective on that. Mish is Chief Market Strategist at marketgauge. The idea right now, Mish, nice to see you, by the way, of a softening economy seems to win over some investors who are concerned about more interest rate hikes. What do you make of the daily swings we see in the market right now?
What's so interesting right now about the whole bond narrative is that we have seen so many people jumping into the TLTs thinking it's bottom. And of course, that's been the pain trade of the year. And yesterday might have been a huge capitulation. The volume was screaming. So it's possible, especially since we heard a little Fed speak yesterday about maybe cutting in 2024, that investors will get encouraged by that we're near the top of the yield spike. But it's not necessarily good news. And that's, I think, what we really have to watch out for at this point, especially if we're looking at the inside sectors of the economy, like the small caps and the retail and the transportation. They're at a very key point right here. They're sitting, particularly IWM or the small caps, are sitting on an 80-month moving average, which is a 6 to 7 year business cycle. And John, what's fascinating about that is since 2010, it only broke once, and that was during COVID. So it's been holding this sort of no recession line in the sand for a long time. And if we get a break of that, then I think what the market's telling you is that we're in for some trouble.
So that's context on a chart. The bond story is often told just through the price action itself, like where the yields are. And I asked a guest earlier this hour, what's the significance of that? And the response was that, well, it means that if you're big investors or pension funds and what you get paid to be in bonds is more rewarding than the stock market, then money starts to flow into the bond market and puts pressure on stocks. Now, another thing I've heard from people who keep saying, watch these yield levels, is that ultimately it means borrowing costs for businesses are higher, and then that ultimately can hurt profitability, and then we can rely less on some of the current earnings expectations. Those are just a couple of the ideas out there. What is it about the actual price action in bond yields that you're watching?
Basically, I'm watching what the bond yields are doing versus what the core inflation rate numbers are. Because if we can get them sort of matched, then we do have a possibility of averting some kind of a recessionary disaster, or I think more a stagflationary disaster. So that's what I'm looking at, obviously, is going to be inflation. We've seen a lot of prices come down. If we're going to go into recession, obviously, we'll see commodity prices fall further, in which case we might see those yields come down as well. But at this point right now, the inflation is not necessarily the way people think. We have so many other things going on under the surface besides the debt and besides the government being a little bit chaotic right now and strikes, Kaiser Permanente going out today, and that's a trend. Wage inflation. People are starting to feel very frustrated by things here in the United States on multiple levels. And what that could do is actually keep the Fed tight while they watch to see what inflation numbers do based in the services and the wages, as opposed to the classic oil and food prices, et cetera. So that's the balance I'm looking at right now in terms of yields and PCE, core inflation, et cetera.
Okay, I got a final question for you. I want to come back to tech stocks. We had a guest on our program last hour here at BNM Bloomberg who had a lot of conviction around growth names longer term. Just doesn't think that at the end of the day, for anybody who's investing for at least a few years or certainly for the long term, that there are a lot of good options outside of that kind of area. Growth obviously led the charge at the beginning of the year. I will remind our audience that when you see the kind of start to the year that we saw, and then you see stumbles into September or August and September, actually history is on the side of some year-end rallying. So we're not seeing it so far in October. But what is your outlook for the growth names that everybody couldn't get enough of just a few weeks ago?
These are definitely the points, what you just mentioned, that seasonality, pre-election, stocks go up, and growth obviously will lead the charge because that's been the attractive Magnificent Seven. But on the other hand, I think you really cannot dismiss the impact of what happens if we start to see more death in IWM or the small caps or in retail or definitely in the transportation, because that will weigh as an anchor on those growth stocks regardless. We have a spread now that's historical at about 22% in terms of the difference between what's happening with small caps and growth stocks. And you have to ask yourself, is that sustainable? Obviously, over long term, we can see those companies will continue to reign supreme, but that doesn't necessarily mean I'd be flocking in because of some seasonality right now. I'd want to see what happens here with the dollar, with the yields, and of course, definitely I'd want to see what happens with these inside sectors if they're going to start to relay some kind of recession on the horizon. Not good for growth if that happens.